Good afternoon, everybody. My name is I'm Matthew Mickleborough, and I host the podcast and newsletter Junior Resource Investing. I'm excited to talk this one through with Connor today, but before I get into it with him, let's just get some housekeeping out of the way as always, right? So just so we're all on the same page, this is currently being recorded, and the recording will be available on YouTube afterwards. There is a question and answer component to this, so I really encourage people to get your questions into the chat, and I'll do my best to either fit them into the conversation if it's organic, and if not, we'll have a little Q&A session afterwards as required. And as always, right, if you've listened to these before, just bog standard disclaimers, right? We're not your financial advisors. This is not financial advice, right? This is just for entertainment and informational purposes only. Anyway, the name of this panel is Evaluating Matters. How to value Fireweed Metals with PI Financial. And yeah, this is one that I am quite excited for. Connor Mackay is joining me of PI Financial. We're going to discuss Fireweed. And I guess I'll start this by saying that I'm going to guess that everyone listening in today has been in that frustrating and intimidating position of trying to objectively value a company and then just getting your head spun around in the process, right? Like, what risks should I include? What weight do I put on that risk? And then maybe most kind of bedevilingly, right? Why does the market and analysts and firms seem to come up with a valuation that's so different than mine, right? What am I doing right? What am I doing wrong? What am I missing? What do I need to know that I don't? And Fireweed especially is kind of frustrating in this regard because, if you're here, it's best in class. It's a world-class deposit or series of deposits, and has had some love. Their technical team is award-winning. CEO Brandon McDonald is up for Executive of the Year award presently, right? But despite all of this kind of objective facts, it still struggles to gain that steady northward footing sometimes in what is obviously a tough market, right? So I'm hoping that Connor, who has worked as a base metals research associate for PI for the last 3 or 4 years, might be able to shed some light on the topic for us. And I will give kudos to PI here. I've gone through their work and the coverage initiation they did in the last few updates with Fireweed, and they do produce good work. That's not always the case, and so kudos to them. Anyway, Connor, with that out of the way, welcome and thanks, and how are you?
Yeah, thanks, Matt. I'm happy to be here and appreciate the kind words on our research there.
Yeah, no, excellent. And so the way that I framed this is that I think that, let's kind of start general and then funnel down to the specific, right? And so we will obviously end up talking about Fireweed, but maybe just, like I say, general analysis, valuation process questions, start there before we get to that. Can you just run us through your process? Where do you start? How long does it take before you typically come to a positive or negative decision? Where do you end? That sort of stuff. Can you kind of summarize that for us?
Yeah, you bet. I would say and would caution a bit that there's not exactly one path that this process follows. It all starts from general market awareness, keeping an eye on drill results that are coming out, attending conferences, trying to get in touch with as many management teams as possible. And then from there, we can start to narrow down, what projects look promising, what looks interesting, what's got the market's attention, which management teams are more serious about the technical aspects of the project versus, just making a buck for themselves is I would say an important consideration as well in the process.
So maybe as kind of an off-the-cuff follow-up, could you provide some color on, you talk about that distinction between the true technical interest in discovery versus sort of self-interest in self-enrichment. Are there kind of cues or signs that you look for that help with that?
Yeah, that can obviously be a pretty tough one, especially if you haven't had personal interactions with the management team before. But I would say you can often tell. It starts with the technical disclosure that the companies produce. If companies rely too heavily on the copper equivalents or the zinc equivalents with potentially bloated numbers or I think disclosure is a big one there, and just bringing it back to Fireweed, you'll note that the most recent news release from the company was the announcement that their entire drill database has been made available online. We see a lot of these Lundin Group companies sort of following that lead in terms of making as much data available to the market as possible to really pull back the veil and say, look, we've got nothing to hide here. We really stand behind what we're doing at this project, and I think that goes a long way.
And I totally agree on that, right? I think that if you haven't heard that news, go look. Full database, 3D modeling, searchable, customizable on your end as the investor. And so huge news there. I agree. Just to kind of keep things moving here, though. So yeah, we kind of talk about deal breakers, right, and deal makers. But are there things that maybe otherwise that you could maybe point to that what are some elements that kind of, to be cheeky here, pathfinder elements for companies is how I kind of phrase it, right? But what are the things that you find that tend to be found only in winners, or conversely, things that you find that tend to be found only in losers? If you can kind of answer that one.
I think something that really sets the winners apart is kind of a dual focus on advancing, the known parts of the project, what's been drilled out previously, and getting the technical studies and the resource updates to the market in a timely fashion, but also keeping that blue sky upside alive, and having a project that has the potential to grow significantly beyond what is already known in the market. So again, bringing it back to Fireweed, the McMillan Pass property, the Tom and Jason deposits, which are the subject of the current resource update and the 2018 PEA, present a very compelling opportunity. But then, in 2019, the company started drilling out the boundary zone. That's kind of the start of the unknown there. But then when you zoom out even more and you look at the entire 40 plus kilometer long what they call the fertile corridor of their land package there's sniffs of zinc and lead silver mineralization all the way up along that entire valley, and that just leaves open the possibility of maybe the best is still yet to come in terms of the company's journey and what they're able to deliver on the exploration front, while also advancing the project in terms of we've got a resource update coming up in the next couple months here to be followed by an update to the PEA. So yeah, it really is about balancing both project development as well as the exploration upside.
All right, thank you. And so switching gears here, right, just kind of, like I say, kind of meandering a bit around just general kind of concepts here. And I'm going to ask your personal opinion, and maybe it's a PI financial stance as well, but risks and opportunities, what is something on either side of that coin, right, upside and downside? What do you think is being underestimated by the current market in this sector?
Yeah, I think the underestimate really comes down to costs and both capital and operating costs. Inflation has been a key theme across the sector, and we've seen a lot of projects that are currently under construction experience some of those big capex blowouts. But I think the market is still, especially when it comes to developers and explorers, relying on technical studies that even 1, 2, 3 years 3 years old would be probably way out of whack in terms of the prices and cost estimates that they have, especially for the initial build there. So I think that's a key risk that's still being underestimated, as well as your standard permitting timelines, jurisdictional risks, getting social license to not only build, but to continue to explore some of these projects out there is much more in the forefront these days than it ever has been.
Mm-hmm. And I kind of, you were helping me kind of, to switch gears here again, talking about risk weighting. And I know that this can be kind of simultaneously, and it is always simultaneously qualitative and quantitative, right? But can you just explain your risk weighting, right? I mean, how you use it, how much, how granular do you get, right, in terms of jurisdiction you talked about, right, or in terms of the size of the project? I mean, what can you maybe give us some examples of different risk weighting and different risks that you ascribe to different aspects of Fireweed in particular?
Yeah, for sure. I mean, I think it really comes down to sort of three key factors. That would be, we touched on the jurisdictional risk a little bit. Technical risk, I think, is huge. Whether or not, the company will be able to deliver on, the models that we estimate, or the production or costs that we use to value the company as a whole. And then finally, the financing risk that the company faces. Are they going to get backed into a corner where the market knows that they're running out of cash, and they know that a big financing is coming, and they know it's going to be at a big discount in order to get it over the line. All these types of factors can affect, can heavily impact share price in the near and longer term.
And so maybe I will ask, as again, as a follow-up, just specific, particular to Fireweed. I mean, can you give us a little, not to ask for the secret sauce kind of thing from PI, but I mean, can you discuss how you've weighed Fireweed according to those things?
Yeah, I mean, I think it really comes down to the target generation really comes down to two key factors, the discount rate and then the target multiple based on our discounted cash flow model. For me personally, and I mean, there's different schools of thought on this, and different analysts will apply their own sort of metrics, but I like to think of the discount rate accounting for some of the more, project-specific risks, such as technical risk. What stage of technical study has the project advanced to? Jurisdictional risk. Is it in an area that's seen, political or social instability affect the rate that these projects can be advanced? And then, like I said, financing risk is really taken care of with the multiple, which we're essentially saying, if you value a company at a 0.5 times multiple, we see the company essentially having to give up half the current value of the project in dilution in order to continue to advance it.
Mm-hmm. Okay, and well, on the concept or on the topic of discount rates again, let's jump to that, because I've got a few ones here for you, and this is where I will sort of officially transition into Fireweed as well. But still, just working generally here, there's Twitter conversations or X conversations, and some talking heads in the industry around that maybe we should be increasing discount rates because of inflation and the ability to the borrowing rate that these companies can work at or operate at. How much that, I guess the specific question I have is, how much does the borrowing rate that a company can borrow at factor into your discount rate? I mean, if you see a project that's, 3/4 funded at financed at 7%, do you go with 7% for your own discount factor, or how much does that factor into that?
Well, I would say, looking at Fireweed more specifically, the company obviously has no debt at the moment. So I would say the borrowing rate is less impactful in our valuation there. I mean, I would say it certainly comes into consideration more so when you're looking at producing companies or companies that are in that sort of construction financing phase. But more specifically looking at Fireweed, I mean, we model their or value their projects at a 12% discount rate, which is quite high. Most technical studies look at 7, 8, maybe even up to 10%. But the reason there is really the key technical risk. Our model is based off of our internal estimates for what we think the project is going to look like. That's not supported by the full scale engineering work that goes into a technical study. So we tend to be a lot more conservative on that front. And then as the project advances and they come out with a updated PEA and then into PFS and potentially feasibility studies, that we see that technical risk decreasing with time, and then you can start to lower the discount rate that you apply to these projects.
Mm-hmm. Well, and you are a base metals guy, right? Base metals analyst, and so again, anybody here is probably no doubt aware of that, the kind of the discount penalty that base metals projects have, right? Precious metals at the 5, and like you say, base industrial metals 8 or 10 or higher in your case. I guess, is that warranted? I mean, to me, if I see a high quality base metal product, industrial metal projects, that's some of the best money makers in the world in terms of projects. Mm-hmm. And so how much of that is just industry tradition, and how much of that is actually warranted, and why or why not, in your opinion?
I think traditionally, yes, the base metal space has seen a higher discount rate applied to it. And I think the school of thought there is really based around two factors. The cyclicality of the sort of industrial metals complex tends to be a bit more volatile than what we see in the precious metals space. And then also base metals mines, especially the larger operations, tend to operate much closer to or at the margin. Where swings in price can have huge impacts on, or small swings in price can have huge impacts on the potential earnings and cash flow generation of a lot of these projects. So that's where the higher discount rate comes in again, a bit of a proxy for risk in that sense. But what we are seeing in the precious metal sector now is, inflation is starting to bite, as inflation is starting to catch up, and we are seeing margins squeezed a lot more than in the past because of this. So potentially, it's time to see that that sort of discrepancy between the traditional base and precious metals discount rates tighten a little bit. But I think for now, the base metal sector is still penalized a little bit more in that regard.
Is that a potential edge for investors, that recognition that maybe kind of industry tradition is providing a bit of a discrepancy, do you think? Or
yeah, I think so, and I think it's already starting to be reflected in the share prices of a lot of these precious metals miners, and developers. Again, this isn't my sector, but we are seeing valuations hit pretty hard, especially on the back of fourth quarter earnings and guidance for a lot of the major miners here that show pretty significant cost inflation and like I said, margins being squeezed. So I think that recognition is coming and it is starting, but I think there's obviously a lot more value to be squeezed out of some of these, especially base metals developers that have a real shot of advancing quickly along that development pathway. Like Fireweed again, really like the name, not only because of the exploration upside, but like we touched on previously, the real potential for the company to keep advancing this into production eventually.
Mm-hmm. Well, why don't we transition to Fireweed, and I'll finish off on the discount rate on that topic in particular, and then we'll kind of get into Fireweeds properly here. But like you referenced it already yourself in your works, and we would encourage people, PI Financial, try to track down the reports that they do. They're strong and research and evidence based. But 12%, which as you yourself said is pretty conservative, right? I guess and you kind of have already alluded to this a bit, but can you just show your work a bit on why you can justify that 12%, and then maybe also thinking, that the staircase down that this has to take, what benchmarks do you have to see happen for that to get lowered to 10 or 8 or whatever?
Yeah, so again, we selected the 12% discount rate to really reflect the fact that our estimates are based off of even pre sort of resource estimates of the project's potential. The resource at McMillan Pass hasn't been updated since the 2018 PEA, and completely excludes all the work that the company has done over the past 3-4 years in the boundary zone there. That has really been the main exploration focus of the company over that time, and has produced some absolutely spectacular results that just keep getting better, especially as we saw with the most recently wrapped up drill program there that discovered this continuous, much higher grade massive sulfide zone through the middle of the zone, or through the middle of the boundary area. So as we see, the project advance in terms of getting that resource update out, that's coming, or expected to be coming in the next sort of couple months here. And then eventually feeding that into an updated PEA that incorporates an operating scenario at the boundary zone. Once we start to see the engineering and the work behind that, that's when we can get a little bit more comfortable in reducing the technical risk penalty, if you will, on the discount rate there, and potentially move it down towards 8%, 10%, 8%, somewhere along those lines.
Okay, so once they get formally enter the kind of the economic study path, we can expect a decrease in that risk factor. Okay, fair enough. And so let's talk about market evaluation though, right? Because I think I started this conversation, my preamble, saying, Fireweed is a clear winner to me, right? It's massive, best in class, and there's always that traditional logic is to go for best in class. Clear pathway to commercialization, if you ask me. Very smart leadership, very smart technical team. Great investor base, right? From the retail that are there, that are informed, all the way up to institutionals, and but yet it's still seems to languish in terms of that discrepancy between price and value, right? And so there's always, as an investor, you want to find that, but eventually you also want to see value catch up with price, or rather, sorry, the other way around, right? Price catch up with value eventually. And so, I mean, what's going on, right? And I guess that's going to be a rather large and loaded question for you. And obviously, an easy answer is it's just the market right now, and that wouldn't be wrong. But I guess I might ask you to try to step beyond that too, right? Is it that is it something that we don't understand zinc and tungsten as the market? Is it that maybe there's doubt in Western commitment to critical minerals? I mean, what's the reasoning behind this extraordinary project stuck not achieving extraordinary valuations yet?
Yeah, I think a lot of it does come down to a little bit of it does come down to the metals mix. Certainly, I mean, there's just a lack of comparable projects out there in the zinc space, and then when you talk about tungsten, there's almost zero, right? And it's a much more opaque market. And so I think the market is a little bit less comfortable with these more specialty metals, not so willing to pay up. And it doesn't help that the zinc price has come under a lot of pressure lately, more so than the base metals complex as a whole, I would say. But that being said, that's kind of where the leverage that this project has really comes from, is being a little bit unknown still at this point, and having the focus off of these more specialty metals. But I think as governments progress more along this path towards securing critical mineral supply, particularly Western governments, I mean, we've already seen the U.S. Department of Defense step in and provide funding for the Taylor Hermosa project. That's a massive, silver, lead, zinc, manganese operation that was recently sanctioned for construction by South 32 in Arizona there. Once more pieces of the puzzle like that start falling in line, and people wake up to the fact that there really is no Western supply of, or limited Western supply of zinc, especially in Canada, even more so limited Western supply of tungsten, which is almost 100% produced in China at this point. Governments certainly see the need there to advance some of these projects. I would say the U.S. government is a little bit ahead of the curve on that compared to the Canadian government, but they're often the first movers, and it's nice to see that some of these promises in terms of government funding for critical minerals projects are coming true. So I think once we see more of that, we might start to see the value discrepancy sort of close on, especially when it comes to a fireweed.
Okay, and so I'm going to ask you kind of a personal opinion here, in terms of that every good project is also at least in one part a story, right? And so what part of the fireweed story, if you were in charge of the narrative around fireweed, it could kind of plug and play as you need to. What do you particularly see needing clarification or further demonstration? Again, even if it is just more storytelling, to see that valuation gap with the price start to close, where the price will increase to more closely align with the massive confirmation potential that it already has demonstrated.
I mean, I think the company's done a fantastic job in terms of the storytelling, and especially in securing capital. I mean, with the Lundin Group investment towards the end of the year, I think in 2022 is when that occurred. That was a huge leg up for the company, and they've done great work, like I said, with their data transparency initiatives and pushing that forward. I think they're stuck in a little bit of a dichotomy between this is the classic sort of junior explorers issue of having two great projects, and really the market's only ever going to give you value for one. So I think just as they continue to advance the two projects, I think there's a different set of investors that care more about the zinc asset, and really just could care less about the tungsten asset. But then you've got potentially a different set of investors that would like to see the tungsten asset spun out into its own vehicle to continue to advance and get more value recognition that way. So I think nothing specific that the Fireweed team can do right now in terms of getting the story out better. I think they're doing a good job of that, and this is, as the two projects continue to advance, just I guess more a clearer picture on how to extract the maximum value from both projects, let alone as opposed to keeping the focus on the flagship or vice versa.
Mm-hmm. No, and you're right. That is a kind of a classic conundrum for juniors that are the double-edged sword of having two great projects or multiple potential flagships. You talked about Zinc, and obviously this is a huge part of the story. And I mean, it's if you're niche enough to know Zinc, you know that Zinc there is a potential huge kind of supply crunch incoming, right? In terms of a bottleneck, in terms of supply and demand. And I think that you this is a huge part of the Fireweed story, and you want yourself touch on it just now, that kind of North America almost needs Fireweed to meet this incoming demand, right? But do you want to just maybe set that out for us, right, as the base metal analyst? I mean, the supply constraints are incoming. Why? How big? Potential kind of arrival dates for that, right? When do we see this start to come online as actual risk for Zinc supply? And then maybe like you said, almost without peer, but are there other potential projects that could even come close to coming online in time to meet that depletion from maturing mines, instead of Fireweed, if that all makes sense?
Yeah, I think I get what you're trying to get at there. Just in terms of the zinc market as a whole, I mean, obviously the focus right now is on what's happening with the Chinese economy, much like most of the rest of the base metals space as a whole. China is by far the number one metals consumer in the world, and with the collapse of their real estate market, we've seen residential construction, which was driving a lot of that metals demand, has really come to a screeching halt, and so that's been impacting prices. The zinc market is kind of interesting in the fact that a lot more of the mines operate at the higher end of the cost curve than say the copper market, that is more dominated by where supply is more dominated by a smaller subset of these truly world-class massive operations that can turn a profit at virtually any price. The zinc market is much more, or the zinc supply is much more sensitive to cost inputs and the price of the metal, and therefore we tend to see a lot of mines or more mines shut down and spool up in response to price action. So we're already seeing some of the higher cost mines wind down operations. We saw in 2022 energy prices hitting zinc smelting capacity. And so I think a lot of that is really contributing to a lot of pent up, supply side pressure that's coming once the demand side of the equation sort of works itself out. And in terms of the demand side of the equation, it really is at this point in the near term dependent on what happens with the Chinese economy. I mean, the government there has continuously proposed and potentially enacted stimulus measures to kind of prop the construction market up. But in terms of whether that's going to be enough in the near term is yet to be seen. But one thing's for sure is that as the longer lower prices drag on, I mean, the more of these, the more of the production that's going to get idled, or the more of these projects that are going to get shelved, and the bigger the bigger the supply gap gets towards the end of the decade, when we start to see a lot of these reserve lives run out on more mature assets.
Mm-hmm. Well, and like you say, I mean, the cure for low prices is low prices in terms of that supply gap, right? I wanted to go back. You talked about, I should have asked this one previous to this one, but you talked about, this idea that you have these compelling projects, 2 or 3 compelling projects that it's just tough to get full valuation from the market for. Speaking to Gunner River particularly, do you think the market's giving it any value whatsoever? I'm going to guess the answer is no. But then did you give them, in your analysis, did you give them any valuation for that project?
I think, well, the short answer there is no. We don't currently ascribe any value to Gainer River in our target, but I see that project really being an all or nothing, win or status quo, no value for the company. The analogs, the geological analogs to the highest grade zinc mine in the world, Kipushi, are very real and very compelling. But at the end of the day, this is about as remote as it gets in terms of mineral exploration, and they basically have to find another Kipushi up there in order to make the development worth it, because you're going to be running roads hundreds of kilometers, or need to run hundreds of kilometers of roads in through some of the most unforgiving terrain that this country has to offer in order to access a project there. But that being said, if they find something comparable, and I mean, for example, Kipushi, I think their first few years of the mine life, they're mining 30+% zinc. I mean, that is pretty much, that is literally as good as it gets. So, yeah, and that's the prize that they're going after.
Yeah, absolutely. And I guess I'll just take a second here, because I'm going to switch gears and just encourage the audience. If you have questions, fire them in. I think most people weren't here when I kind of offered that at the beginning. So if you have questions you want me to ask Connor, then please get them into the chat for me. But Connor, switching gears here. Your NAV ratio that you use as a benchmark is 0.6. And so I guess, I'm going to ask you the question I've asked a couple of times. Is this, can you just show your work a bit, right? Explain, justify your metrics. And if you can, and we talked about this beforehand, maybe the struggles about this particular aspect of that, are there peer comparisons that you can make, whether that's current valuations or takeout valuations that you use to justify 0.6?
Yeah, so I mean, I think when it comes to a lot of these development type stories, the way I start off looking at it and say at a 0.5 times multiple level, if it's kind of a standard story with a lot of value, but a lot of work ahead, that multiple years of exploration programs before you get into the potential of project financing and that kind of thing. And then you can either penalize the project if there's higher risk, i.e. Big lower grade porphyry that's going to require $1 billion plus in capex to get it built. Those projects tend to trade at a pretty significant discount to peers, whereas these higher grade, high margin underground type opportunities tend to trade at a premium, because you can get similar levels of production out of these mines for a couple $100 million in capex versus, like I said, that multi-billion dollar level. So for Fireweed, not only do we see it being that sort of lean, mean, high grade type opportunity that is financeable as a junior, potentially, if it came to that. But you've also got, the Lundin angle in terms of offering, continued exploration financing at very favorable terms. Most of these, most of the capital raises that they've done in the past have been at basically at the market level or at a slight premium, which is a huge advantage compared to the vast majority of exploration companies out there, where you see financings coming in at a discount to market and with warrants attached in order to get the deal over the line. You're not going to see that with Fireweed, or at least in our view, you're likely not going to see that from Fireweed. So that's another sort of factor that bumps up our calculus when it comes to assigning a target multiple. In terms of comps out there, yeah, I mean, we've touched on this. There's not really a whole lot in the zinc developer space. A couple names from my coverage universe that I would point to. We look at, for example, a Foran Mining is kind of what we expect Fireweed might look like in 3 or 4 years' time, where it's a high grade Canadian base metals development opportunity. Trading up in that sort of premium territory of a 0.8 to 1 times NAV. There's a fair bit of work to get there in terms of development and continued exploration, but that's the real prize here. Or even looking down at South America, one of the other Lundin companies, NGX Minerals, we see them trading at about a 0.6 times NAV, and that's again one of these world class high grade underground opportunities that if it really came down to it, you're talking about a few $100 million in capex versus multi-billion-dollar development.
Okay, no, thank you. And it kind of snuck up on me, but I think this is almost my last question here. And honestly, and I'll let you at the end of it have the floor as well to touch on anything you would like to that you think I missed. But just core remaining risks, right? I mean, what does Fireweed have to demonstrate before you're willing to kind of give it a risk value of 1 and just say, this will be a mine. It's just a matter of making it happen.
Yeah, I mean, I think it's all the factors that we've touched on previously, just continuing to advance the project from a technical standpoint, getting that resource update out there, getting the PEA update that includes the boundary zone, continuing to push permitting along. The Yukon government previously committed 70 million Canadian for road upgrades to the project. Seeing some of that funding come through and that work start would go a long way to showing the actual commitment there from a jurisdictional standpoint, as well as continuing to make new discoveries across the property. This year's drill program was really focused on drilling out boundary to the fullest extent so that they could get that resource update or as much data as possible into a potential resource update. But in future drill programs, we'd expect the company to start branching out and stepping out and testing some of these new, exciting targets along that, like I said, 40-kilometer favorable structural corridor that runs the entire length of their property.
Yeah, good. And I think that you articulated well. This is, like I say, we have kind of come to the end of it. It is one of my favorite projects in the market right now. Kind of what you would argue is bargain basement valuations right now. But Connor, I mean, is there anything that you wanted to talk about or discuss that you think maybe I missed in terms of this conversation?
Yeah, I mean, I guess I would just touch on, what to expect from the company over the next little while, or what we expect the company to deliver for the next little while, now that the drill program is complete and all the assay results have kind of been released to the market. I've touched on it again previously, the resource update that we expect to be coming based on this year's drill programs. That's expected sometime in the next, sort of call it 2 months here. Around that same time, we'd expect to see an updated economic study wrapped around Mackay, so a PEA most likely based almost entirely on historical work, but including the updated metallurgical work, which was a key aspect of the project that Fireweed was working on in parallel with their Mackay drill programs. Two major catalysts to look forward to kind of in the middle of the year here before we really start to look ahead and beyond at the next season's drill programs that we'd expect to kick off later in the year.
Good. That's a good one. Thank you that's a good one to catch up for me there. Thank you. Otherwise though, Connor, I think that's it for me. And it looks like I don't think I see any questions coming up. Just Adrian says thanks to both of us. So yeah, Connor, thank you for your time, and thanks to Six for hosting us, and thanks to Fireweed Metals for having a heck of a couple of projects. And yeah, Matthew from Junior Resource Investing. Have a good day, everybody.